Hello, everybody. At this time, we are talking about commercial paper. Commercial paper refers to a short term unsecured debt obligation that is issued by financial institutions and large corporations as an alternative to costlier methods of funding. It is a money market instrument that generally comes with a maturity of up to 270 days. Commercial paper is sold at a discount to its face value to compensate the investor as approved to paying cash interest like a typical debt security. In other words, the difference between the face value at maturity and the investor's discounted purchase price is the investor's profit. The need for commercial paper often arises due to corporations facing a short term to cover expenses. And then move to commercial paper characteristics. Commercial paper is an unsecured form of promissory note that pays a fixed rate of interest. It is typically issued by large banks or corporations to cover short-term receivables and meet short-term financial obligations, such as funding for a new project. As with any other type of bond or debt instrument, the issuing entity offers the paper assuming that it will be in a position to pay both interest and principal by maturity. It is seldom used as a funding vehicle for longer term obligation because other alternatives are better suited for that purpose. The commercial paper provides a convenient financing method because it allows issuers to avoid the heartless and expense of applying for and securing continuous business loans and the Securities and Exchange Commission or SEC. And SEC does not require securities that trade in the money market to be registered. It is usually offered at a discount with maturities that can range from 1 to 270 days, although most issues mature in 1 to 6 months. And then, what are the risks of commercial paper? The primary downside to commercial paper is that companies are restricted to using the proceeds on current, namely inventory and accounts payable. Specifically, the cash received as part of the commercial paper arrangement cannot be used to fund capital expenditures. Commercial paper is an unsecured form of debt, meaning that it is backed merely by investors' trust in the issuer. In fact, only large corporations with high credit ratings can issue commercial paper at favorable rates and with enough liquidity. Commercial paper is a short-term debt instrument issued by companies to meet immediate financing needs. Commercial paper must be repaid in full on the date of maturity, or else the borrower is at risk of default. And then we move to types of commercial paper. Promissory notes. Promissory notes are written promises to pay a specific amount of money on a certain date. They are used by companies to borrow funds without having to use collateral, and promissory notes can range from just a few days to up to a year. And then second, repurchase agreements or repos. Repurchase agreements involve one party who sells securities to another with a promise to repurchase them at a specified price on a future date. Then third, drafts. Drafts are orders written by one party directing another party to pay a specified sum to a third party. The drawing is usually abandoned. And fourth, certificate of deposits or CDs. Certificates of deposit are time deposits issued by banks that pay a fixed interest rate for a specified period. CDs are considered low-risk instrument and low-risk investment since they are backed by the issuing bank. However, there may be a dollar or rupiah as to the amount that is insured. And then if bankers' acceptance. Bankers' acceptance are time drafts that are accepted and granted by a bank. They are commonly used in international trade to ensure payment to exporters. And then we move to features of commercial paper. The first feature, unsecured nature. Commercial paper is typically unsecured, meaning it is not backed by collateral. This characteristics relies heavily on the issuer's creditworthiness and reputation. Issuers with high credit ratings issue commercial paper without backset, making the process quicker and less cumbersome. And then second, credit rating. Issuers often obtain credit ratings for their commercial paper from recognized rating agencies. High credit ratings enhance investors' confidence and reduce borrowing costs. Investors rely on these ratings to assess the risk associated with the commercial paper, making it easier to make informed investment decisions. And then third, short-term maturity. Maturity ranges from a few days to a year, with most papers maturing within 270 days. This short-term nature makes it an ideal instrument for managing immediate financing needs. The quick turnover of these instruments aligns well with the short-term liquidity requirements of both issuers and investors. And then fourth, liquidity. High liquidity due to short maturities and active secondary markets. Commercial paper can be easily bought and sold before maturity, giving investors flexibility. The liquid nature of these instruments makes them an attractive investment for entities looking to manage their costs, to manage their cash flows dynamically. And fifth, issued at a discount. Commercial paper is sold at a discount to its face value. The difference between the purchase price and the face value represents the investor's return. This structure simplifies the interest payment process as the return is realized at maturity when the face value is paid. I think it is enough. Thanks for watching.